Hey everyone, and welcome back to the channel. Today, we redive in deep into one of the most popular and versatile technical indicators out there, the MACD. That stands for Moving Average Convergence Divergence. Now, I know that sounds like a mouthful, but trust me, by the end of this video, you will understand exactly how it works and how you can use it to potentially improve your trading decisions. So, what is the MACD? Really, at its core, it's a trend-following momentum indicator. It shows the relationship between two different moving averages of an asset's price. The goal is to help you spot changes in strength, direction, momentum, and the duration of a trend. It sounds complicated, but it's actually made up of just three simple components. Let's break them down one by one. First, you have the MACD line itself. This is the heart of the indicator. It's calculated by subtracting the 26-period Exponential Moving Average, or EMI, from the 12-period EMI. The 12-period IMA is faster and more responsive to recent price changes, while the 26-period IMA is slower. When the faster EMA pulls away from the slower one, it signals increasing upward momentum. When it moves closer, momentum is slowing down. Next up is the signal line. This is a 9-period IMA of the MACD line we just talked about. Think of it as a smoothed-out version of the MACD line. Its job is to act as a trigger for buy and sell signals. When the MACD line crosses above the signal line, it's often seen as a bullish signal. Conversely, when it crosses below, it's considered bearish. We'll look at specific examples of these crossovers in just a bit. The third and final component is the histogram. This is my favorite part because it makes everything so visual. The histogram simply represents the distance between the MACD line and the signal line. When the MACD line is above the signal line, the histogram will be positive, shown as bars above a central zero line. When the MACD is below the signal line, the histogram is negative, with bars below the zero line. The height of the bars shows you how strong the momentum is. Taller bars mean stronger momentum, and shorter bars mean weaker momentum. Alright, so now that we know the three parts, the MACD line, the signal line, and the histogram, how do we actually use them to trade? The most common strategy is looking for crossovers. Let's start with the bullish crossover. This happens when the MACD line crosses up and over the signal line. This suggests that the upward momentum is starting to build, and it could be a good time to consider buying or entering a long position. On your chart, you'll see the blue line crossing above the orange line, and the histogram will flip from negative to positive, starting to form bars above the zero line. On the flip side, we have the bearish crossover. As you can probably guess, this occurs when the MACD line crosses down below the signal line. This indicates that downward momentum is increasing, and it might be a signal to sell or enter a short position. You'll see the blue line dip below the orange line, and the histogram will turn negative, with bars appearing below the zero line. Another powerful way to use the MACD is by looking for centerline crossovers. The center line is the zero line on the histogram. When the MACD line itself crosses above the zero line, it's a sign that the 12-period EIMA has crossed above the 26-period EIMA. This is a broader confirmation of an up. It's a slower signal than the signal line crossover, but some traders consider it more reliable. Similarly, when the MACD line crosses below the zero line, it confirms that a downtrend may be in place. It tells you that the short-term average price is now below the long-term average price, signaling a potential shift in the overall trend. Now, for a more advanced technique, divergence. This is where the MACD can really shine. Divergence happens when the price of an asset is moving in one direction, but the MACD indicator is moving in the opposite direction. It can be a powerful warning that the current trend is losing steam and might be about to reverse. There are two types of divergence: bullish and bearish. Bullish divergence occurs when the price makes a new lower low, but the MACD makes a higher low. Imagine a stock's price dropping, but the MACD's troughs are actually rising. This suggests that the downward momentum is fading, and a potential reversal to the upside could be on the horizon. It's like the indicator is telling you, hey, even though the price is falling, the selling pressure is getting weaker. Then there's bearish divergence. This is the exact opposite. It happens when the price makes a new higher high, but the MACD forms a lower high. The price is climbing, but the indicator is showing that the buying momentum is actually weakening. This is a red flag that the uptrend might be running out of gas, and a reversal to the downside could be coming. It's super important to remember that divergence isn't a guaranteed reversal signal. It's a warning sign. You should always look for other confirmations, like a candlestick reversal pattern or a crossover on the MACD itself, before making a trading decision based on divergence alone. So, let's put it all together with a quick recap. We have the MACD line, the signal line, and the histogram. We can look for bullish crossovers to find potential buying opportunities and bearish crossovers for potential selling opportunities. We can use the centerline crossover as a broader confirmation of the trend's direction, and we can use divergence as an early warning system for potential trend reversals. One crucial tip: the MACD is most effective in trending markets. When a stock or asset is moving sideways in a range, the MACD can generate a lot of false signals, or whip. This is because the moving averages are constantly crossing back and forth without any real momentum behind them. So, it is always a good idea to use the MACD in conjunction with other tools to confirm the market condition. For example, you could use a longer-term moving average or the ADX indicator to determine if you're in a trending or a ranging market first. Also, remember that the standard settings for the MACD are 12, 26, and 9. While these work well for many traders, you can adjust them. For example, if you're a short-term trader, you might want to use faster settings like 5, 35, and 5 to get more responsive signals. If you're a long-term investor, you might prefer slower settings. Feel free to experiment on a demo account to see what works best for your trading style and the specific asset you're retrading. The MACD is an incredibly powerful tool, but like any indicator, it's not a crystal ball. It should be one part of a complete trading plan that includes risk management, position sizing, and your own analysis. Don't ever rely on a single indicator to make all your decisions. I hope this detailed breakdown of the MACD has been helpful. It's a fantastic indicator to have in your trading toolbox. If you found this video valuable, please give it a thumbs up. And don't forget to subscribe and hit that notification bell so you don't miss our next deep dive into another powerful trading tool. If you have any questions or want to share how you use the MACD, drop a comment below. I love reading them and will do my best to respond. Thanks for watching, and I'll see you in the next video.